Hey everybody, what's up? We are back. Today we are looking at Walgreens. So they primarily operate pharmacies and retail stores. So definitely an interesting company, kind of a popular trade over the past couple of years. A lot of people are looking into this. So I'm going to go through it, look over the financials, some other things. And yeah, so let's get into Walgreens. If you're interested, make sure to subscribe. If you haven't, I make these videos just about every single day of the week. So make sure to subscribe. That's it. Let's get into it. So, starting off, we can see retail, drugstores, health and wellness services, specialty, and home delivery pharmacy services. So, overall, I think a lot of people, especially in the US, have heard of Walgreens before. You know what the company is. But let's look at some key statistics here. So, right now, dividend yield sitting at 9%, which is kind of crazy. Market cap at 10 billion, long-term growth rate at negative 17%, although usually this number is a little hit or miss, just to be clear on that. Target price is at 11. Right now we're sitting at 11, although target price is a little bit higher. Looking at their chart here, the mini chart, we can see they have really taken a hit over the past couple of years. Their stock price has seen a fairly large drop all the way down to right around $8 to $9. Seeing a little bit of a comeback in the past couple months. But overall, this is why their dividend yield is so high, because their stock price has fallen so much. So the percentage per share has increased a lot. However, they're still paying the same dividend, which is good. It kind of shows their consistency. So they are still paying out high dividends, even despite their stock price dropping so much. So that is pretty good there. Looking into their growth summary, we can see nearly across the board, everything is negative. So actually, that long-term growth rate earlier could possibly be correct. But sales are positive. Everything else is very negative, including free cash flow, which is not great. Just based on what the company is, I would say being a brick and mortar retail company that's primarily just pharmacy related things, I would say they probably need to make some big changes in order to continue to grow, or they'll possibly get bought out by another chain. That's always a possibility here, but overall growth summary does not look great. So now let's get into their financials and see what we can see here. So looking into their income statement first, over the past couple years, we can see they are showing sales growth and very consistent sales growth too, actually. Seeing an all-time high in 2024. Also, the unofficial report is showing even higher sales. So looks really good for sales. Operating income is very, very low. Their margins are clearly razor thin, and they've also taken a loss over the past 2 years as well. So overall, pretty rough here. Their sales are perfectly fine. Actually looks really good, but they're just not making any profit on them whatsoever, which is not great. So looking into the income statement here, it does not look very good. Let's go to their quarters and see if there's any kind of recent improvements possibly. So net income has been fairly shaky over the past couple of years. It looks like they took some pretty big losses in 2024, coming out right to around 9 billion with one quarter being profitable. Just based on what I'm seeing, that one profitable quarter is probably from looks like taxes or pre-tax income. So taxes definitely take a big chunk out of it with them. But other than that, I think it's just a ton of SG&A expenses that just kind of wipe out any possible profit they could have, which you can see right here. So their SG&A expense is just their gross income is at 61.54, SG&A is at 61.26 over the past quarter. So their gross income basically gets wiped out immediately. Operating income is almost nothing, at least on average. It is relatively positive, but it honestly doesn't look great. 2024 was a rough year in terms of their operating income, but overall income statement entirely does not look very good for them. Let's go back to the year so I could check out the total shares. So their total shares have actually been fairly steady and coming down over long term. They have come down, but more recently over the past 5 years or so, they've been fairly steady at the same amount, coming down slightly. So nothing really too crazy there. Dividends per share has also been fairly steady for the most part. And that's about it there. Let's go into the balance sheet now, see what we are dealing with here. Now, I'm assuming they're probably lowering their assets, which they are. Overall, they had a high of 96 billion in assets. They're at 81 billion now. So 2024 is definitely a restructuring year for them, just based on the fact that they lost 15 billion in assets. And you can see they do have a lot of cash from that, a lot of inventory. Actually, possibly too much inventory. That could be part of their problem, is they have a ton of inventory and just aren't able to sell it, or it's too expensive to store $8 billion worth of inventory. So that is definitely a possibility here. Another thing to note, they have a lot of debt. They have 20, almost 30 billion in long-term debt, just under 4 billion in short-term. Meanwhile, right now they have a little over 3 billion in cash. So that's definitely an issue for them. I'd imagine their interest expense is probably a lot, which we'll see in a little bit here. But other than that, looks like a lot of the decrease they had came from property, plant, and equipment. So definitely selling off a lot of stores. You can see they had an all-time high there of 34 billion. They're down to 30 billion now. And other than that, intangible assets, that it looks like they decreased a lot as well. So most likely just trying to sell off. Actually, it was a goodwill write-off. So just overall with the intrinsic value of the company kind of getting written down there. But other than that, debt does not look great. And now let's head into the cash flows, see what we're dealing with here. So operating cash flow is positive, although again, very much lower than it used to be. They used to have at least over 5 billion or more in cash flows, and now they're down to 1 billion in 2024, which is honestly really bad. Looks like they're starting to use their investing cash flow to kind of cancel that out by selling off some other funds, it looks like, and also selling off some assets, which they have been selling off assets since 2020 consistently. Other than that, financing activities, you could see they have been consistently paying dividends, which is a fairly significant expense for them, paying off over $1 billion in dividends per year. Um, Honestly, that's just not great overall. So it is good from an investing standpoint, especially now with the share price being so low, the yield is very high. So assuming this company can turn itself around and fix its stock price, which we will get into their chart later, um, it could be a great investment because you'll get capital appreciation plus that high dividend yield right now. So it definitely could be promising in the future, but overall cash flows just do not look great. Free cash flow is actually, they saw negative free cash flow for the first time in a long time in 2024. So that's just another not great sign for the company. Moving on, we could go into their segment history and see they are at all-time highs with sales. They did take a little bit of a hit, obviously, with COVID, but really not much, honestly, and recovering fairly quickly from that as well. So looks okay there, but obviously they never regained the profitability that they had, which we will see here. So their gross margin is at 16, 5-year average is at 18.7. Again, looking at 2020, we saw their highest gross margin in a while, and since then it has only been declining. SG&A to sales is declining as well, which is good, and they are obviously doing a fairly good job there of decreasing it and cutting costs, but it just seems like it hasn't been enough to offset what they've been losing. Their operating margin is basically at a 10-year low currently. Net margin has gone negative for the past 2 years, so they are taking a loss. ROA, ROE are both very much negative now and increasingly negative. So overall, just a lot of negative signs here for the company. There's definitely a lot of work they need to do with the profitability side. And also you can see their debt to equity ratio has exploded over the past couple of years, going to almost 300% now. Looks like before 2020, they did have a very healthy ratio. After 2020, it blew up and has since been not great. Usually around 100% or lower is considered healthy or sustainable. Anything below that is good. So being this far over 100 is just very, very negative for the long-term aspect of the company. So overall, that definitely needs to be looked into. So now going into some recent news, we can get into their earnings report that they set out recently and see if we can see anything interesting. So we have a metrics recap here. This is what I usually look into. And just looking at some key operating metrics, so gross margin was below estimates. Operating margin actually came in a little bit higher, but again, 1.3% operating margin is just unsustainable. I mean, they're really not going to make any profit at all with that. So still that needs to be increased. Revenue did beat estimates. Operating income beat estimates significantly, which we saw here with the margin as well. And then overall, their segment profitability, you could see here, is at 12.7% for pharmacy, and retail actually took a loss. So they're basically just making money off of their pharmacy segment, which does make sense. For their, oh, that is for US retail. So international, they had a very significant revenue beat. Operating income came in lower than estimates, though, and both pharmacy and retail had a profit. So does look good there. And then US healthcare revenue beat, and adjusted operating income also beat very significantly. Was expecting a loss and had a 25 million operating income revenue there. So does look fairly positive for this specific earnings report, but could obviously be better. I think there's a lot of work that needs to be done. Here are some analyst commentaries. So strong stock performance reflects positioning, also sales progress and improved segment performance. Target remains $10. Target raised to $11.50. Target remains $10. Target remains $9. So overall, they're honestly still trading above what the estimates are. So I think what happened was this company was overvalued for a very long time. Although one thing to note, again, if we just head back here and look at their income statement, this is a 10 billion, I think I said $10 billion company that is making $150 billion in sales. So just that kind of multiple is insane, to say the least. Like, that ratio generally makes no sense. Now, obviously, they're making like very, very little profit on that $150 billion. But the fact that they're at this price with that much sales is insane. So looking into a little bit more, free cash flow improvement, no announcements regarding a dividend cut. So that is good. Obviously, I think people are kind of pricing in the possibility of a dividend cut or possibly removing the dividend altogether just because of how low their profits are. But it seems like they're not going to cut their dividend, which obviously people really like. So overall, that is really good. Stronger results despite challenges. Retail performance countered front end pressure. So overall, the analysts here are saying it looks very, very positive and driven by strength on all business lines, domestic and international. Pharma comps offsetting weaknesses in retail, which is really good. A lot of positive things here. So from an analyst standpoint, this looks really good. And with that, let's get into the chart now. So let me just head over there. So you can see with this earnings report, they saw a huge 27% jump. Now, as of this today, the earnings report was just a couple days ago. As of today, they're almost just about halfway through that last jump now. So they are seeing a decline. However, they are holding some of the value so far. At the very least, they're still up about 13% from before the earnings report. So it does look good. Obviously, a lot of people are going to be wanting to sell just based on where the stock price was. I'm sure a lot of people probably were just taking quick profits here just based on the decline that they've seen. But overall, again, highlighting the decline of Walgreens, they had an all-time high of around $96 a share in 2015, actually closer to probably 97, and since then have basically been in a constant downtrend. Now, it does look like there is a support base forming right here. However, this has kind of happened before where they got a little bit of support forming and then just got shot down immediately after. So what we need to see here is continued results. So it looks like they had two positive earnings reports in a row, which is leading to this recent support and a little bit of growth. But overall, we need to see consistency. We need to see profit growth. And until that happens, the company is just probably still going to be stuck in this trading range, at least in my opinion. So next earnings report is important. I think what we need to see is just margin improvement. But overall, that's all I have for Walgreens. Thanks everybody for watching. Make sure to subscribe if you haven't, and I will see everybody in the next video.